Hi, everybody, and welcome to another one of our WESK webinars and our fourth and final session in our October Learning Month with Deloitte series. My name is Josie. I am WESK's marketing advisor. For those who aren't familiar with WESK, we are a nonprofit organization who is focused on helping entrepreneurs start, grow, and scale their businesses. We offer a variety of different services, including business advising, financing, events, and training. And right now, we are offering free webinars every Wednesday on a variety of different topics. So as I mentioned, this is our last topic in our Deloitte series, and today's presentation is entitled Tax 101, and it's presented by Briane Vance, who is an assistant manager at Deloitte, and Andrea Volk, who is a partner at Deloitte. If you have any questions as we go through the presentation today, please submit them in the Q&A box, not the regular chat box, but feel free to use that regular chat box for just chatting with attendees, letting us know kind of who you are, where you're from, what your business is, or any other type of chatter like that. And lastly, as always, this webinar is recorded and you'll receive an email tomorrow at this time with a link to the recording, so keep an eye out for that. Okay, I think we are ready to begin. Briane and Andrea, please take it away whenever you're ready.
Okay, probably be helpful if I unmuted myself. So as mentioned, my name is Briane Vance. I am an assistant manager at Deloitte in Prince Albert. I'm also joined by Andrea Volk, who is a partner in the Regina office. We're both involved with small to medium businesses and looking at the tax compliance, tax advisory, and tax planning for them. So thanks everyone for calling in today. As mentioned, we're going to be looking at some of the tax basics facing individuals and businesses. And thanks so much to WESK for putting all of this on today. I can go next slide. There we go. So just a quick little note on what Impact Day is for us. You might have seen that little Impact Day symbol on the last sign. So these presentations are just a way for us as a firm to try and give back to the community in order to grow it. It's obviously a little bit difficult for us this year because we can't do in-person sessions that we normally like to do. So we're doing these kind of virtual presentations that we also really enjoy. So I think we can get right into it. So as mentioned, we're going to be looking today at the taxation of a business. So here's a little bit of an overview of what we're actually going to be looking at. So we're going to be looking at a few of the different ownership structures and the considerations of those structures, as well as the different kinds of taxation. We'll also take a quick look at some tax planning opportunities, some other considerations to look at for these businesses, as well as some COVID-19 programs that the government has been rolling out these past few months. So the three structures we're going to look at are the sole proprietorship, a partnership, and incorporation. So corporation. So these are the main structures. And we're going to take a quick look at some of the advantages and disadvantages, as well as examples of how each structure is taxed. So we'll first start with a sole proprietorship. So we'll go through some of the advantages. So it is very easy and inexpensive to establish a sole proprietorship. All you really need is just to register the business name. As the business income is included in your personal income, the only annual compliance is filing your personal tax return. There is no annual registration with the corporations branch or additional tax filings. As a sole proprietor, you are the decision maker for your business, so you have your direct control. Due to the low costs involved with establishing a sole proprietorship, there could be minimal working capital required to actually start up. And as mentioned, income from the business is included in your personal income for tax purposes. So this can be an advantage in the years where the business is not doing as well, or in the first few years of startup where you're experiencing some losses, because those business losses can offset your personal income. There's a few disadvantages as well. So as a sole proprietor, you are fully responsible for the debts and obligations of your business. You will have unlimited liability as a sole proprietor, and as a result, creditors can make claims against your personal assets to settle those debts. Income from the business being included in your personal income can also be a disadvantage. So in the years where the business is doing very well, it may push you up into a higher tax bracket and result in additional tax being paid. As a sole proprietor, there may be a lack of continuity in your business should you be absent for a period of time. And lastly, if additional capital is needed for your business, it can sometimes be a bit more difficult to raise that capital. So moving on, we can take a look at the next structure, which is a partnership. So when starting up a partnership, it's key that you establish the terms of your business between you and your partners by drafting what's called a partnership agreement. This should be done with the assistance of a lawyer to ensure that there are clear terms as to how the profits will be shared, details on dissolving the partnership, and to ensure all your legal requirements are met. The partnership agreement will ensure that you are protected should there ever be a disagreement between you and your partners. So we'll get into some of the advantages. It's fairly easy to start up a partnership. As discussed, you should always consult a lawyer to draft up that agreement. In a partnership, the financial resources that you and your partners contribute are combined and put into the business. So as partners, generally you will share in the business in proportion to those financial resources that you have contributed. The legal and professional costs associated with starting up a partnership would be shared among the partners. You and your partnership will share in the management of the partnership. So this can ensure that there is continuity should you ever need to be absent from the business for a period of time. And as with a sole proprietorship, the income of the partnership is included in your personal income. Therefore, in times where there are losses in the partnership, just like the sole proprietor, those losses can offset your personal income. So moving on, we'll switch to the disadvantages. There's no legal difference between you and your business. So as with your sole proprietorship, you and your partners will be fully responsible for the debts and obligations of the partnership, and creditors can make claims against your personal assets to settle the debts. As discussed, there will be legal fees involved in drafting that partnership agreement, so it can be a bit more costly. There's a requirement to file an annual tax return for the partnership, which can result in additional professional fees. So unlike the sole proprietorship, a partnership does actually have one more step in filing for compliance. It may also be difficult to find a suitable business partner. So if you don't already have someone in mind, it may be difficult to find somebody with similar views as yourself. And there's also that potential for conflict or disagreement between you and your partners. And lastly, you are held financially responsible for your business decisions made by your partners. So even though you didn't make it, but your partner made it. So for example, any contracts that may be broken. So moving on to the third structure we'll look at, which is the corporations. So some of the advantages. A corporation is a legal entity that is separate from the shareholders. Shareholders of a corporation are not going to be personally liable for the debts and obligations of that corporation. Unlike a sole proprietor and partnership with a corporation, your liability is limited because your corporation is a separate entity. The shares of a corporation can be sold, allowing for ownership to be transferred. So if your business qualifies, you can use your lifetime capital gains exemption to reduce the tax paid on the sale of shares of your business. Each individual has about $880,000 of an exemption in 2020, and this amount is indexed annually every year for inflation. So if family members are shareholders, you have an opportunity to multiply that lifetime capital gains exemption amount. However, there are specific requirements that need to be met in order to be able to use that exemption, and that criteria is a little bit beyond the scope of this presentation. So moving on, the corporation will continue to exist until articles of dissolution are filed. It can often be easier to raise capital when you are incorporated. It is possible that the corporate tax rates may be lower than your personal tax rates, resulting in less tax paid. So corporations are best if you are earning more than you are spending and can benefit from the tax deferral a corporation may provide. There's a maximum tax deferral of 36.5% that is available due to the difference between personal and corporate rates. And we're going to go into this with a bit of an example later on in the presentation. So now we can take a quick look at some of the disadvantages. So legal assistance will be required to incorporate. Generally, a shareholder's agreement will also be required and would require the assistance of a lawyer. There are also more regulatory requirements for corporations. There is an annual filing requirement for the tax return and additional filings with the corporation's branch. So this could also result in additional costs to the business. The record keeping is more extensive for a corporation, so you will also be required to keep minutes for shareholder and director meetings. And there is always the possibility of conflict between shareholders and directors. So now we've taken a quick look at some of the qualitative advantages and disadvantages of the three structures. We're going to move on and get into some of the specifics of tax. So the table shows the different combined federal and provincial tax rates on different types of income. So note that there are many tax credits available that would reduce the amount of tax payable. However, it is dependent on each personal individual situation. So this chart is only showing the tax rates before applying the related tax credits. In Canada, we operate in a bracket system. So your first amount of income is taxed at a different rate than the higher amounts of income. So if you make over that top limit, that $214,000 in the year, that doesn't mean all of your income is taxed at 47.5%. It means that the lower amounts are taxed at these lower rates, and any amount in excess of 214 is taxed at that high rate. And we have an example to kind of demonstrate what that actually looks like. Okay, so as shown on the previous slide, the highest personal tax bracket in Saskatchewan is your 47.5% when you start earning over that $214,368. So as mentioned, only income over that amount is taxed at that rate. So if you are already in that bracket and you start a sole proprietorship, all that proprietor income will be taxed at 47.5% because it's included in your personal income and you've already used up those low tax brackets. Any amount in excess will be taxed at that higher rate. So here we have an example that shows the consequences if you are not at that top bracket and start a sole proprietorship. So we have someone who is already making $60,000 of personal income, so maybe some kind of employment income, and then they earn an additional $30,000 through a sole proprietorship. So the initial $60,000 would be subject to a rate of about 20.92%, resulting in about $12,500 of tax. This 20.92 is calculated using the bracket system on the previous slide and also applying the basic personal tax credits, which reduce your taxes payable. So like I mentioned, tax credits can be very specific to an individual. However, this basic personal amount is available for every individual. So the additional $30,000 of self-employment income results in the personal income being pushed up into a higher tax bracket. So I believe it's the third bracket at 33%, and is therefore subject to an additional tax of about $10,000. So when we look at the combined rate of these two, it's about 24.95%. So in the second example, you're still earning your $60,000 in your employment income personally, but this time you have a $10,000 loss in your sole proprietorship. So the initial $60,000 is still subject to your 20.92% tax rate. However, that $10,000 loss is going to reduce some of your income. So it's going to reduce your income by about 33%, and it's going to reduce your tax payable by about $3,300. So combined, this creates an average tax rate of about 18.51%. So you can see here that having losses in the first year make it more advantageous for tax purposes to operate as a sole proprietorship as they are applied to your other employment income. Whereas earning income as a sole proprietorship increases the personal tax rate. Now to go over some of these details, we have the actual calculations to show how I actually came to those numbers. So here we have your $60,000 that you're earning, and then we have the three different brackets that this individual will be taxed on. Their first 45,225 is taxed at 25.5%. So you multiply those two together, you get about $11,000. The next bracket is fairly small. It's your 45,225 to 48,535, about $3,000 in there. That's taxed at 27.5%, so $910. And then the rest of your income is taxed at 33%. So you didn't make the top 97,069, you only made $60,000. So you want to make sure only the $60,000 is taxed. So you take your $60,000 minus the amounts that have already been taxed, your 48,535, multiply that by 33%, gets you about $3,700 in tax. We add all those up to get your total tax before your credits of about $16,000. And then we want to take a look at your personal tax credits. This person only has their basic personal amount available, which everyone does. And we apply those at the applicable tax rates. So you'll notice that we split these two out just to look at the federal versus the provincial tax credits, because there are two separate amounts. And they are applied at the federal and the provincial tax rate. So you'll notice that 15% plus 10.5% gives you that first bracket amount of 25.5%. We've just shown it split out here because they're applied at different amounts and different rates. So we apply those credits, which is a reduction to your total taxes. So we get about $12,554 for an individual earning about $60,000. So we compare those two, your total tax to your total income. It's about 20.92%. So now we have a sole proprietor earning your $30,000. That's going to be taxed at that 33% bracket because you've already used up those two lower brackets. So about $9,900 in additional tax. So we combine that addition to tax to our previous amount because we still have that income. So about $22,454 and 24.95% in tax. Lastly, the third scenario, we have a $10,000 loss in our sole proprietorship. So we still apply the 33% because we're having a reduction in that top bracket for the amount that's taxed. So 33% times your loss of $10,000 is a reduction to tax for about $3,300. You adjust that to your previous amount on your $60,000 and you get to $9,254 for total tax. So 18.51%. So this is the same scenario on the previous slide, just broken out to show you how you could actually set up a calculation if you want to take a look at what the tax will look like. So we're going to move on and take a look at integration. So integration, it attempts to ensure that the total tax paid is equal whether you earn it personally or through a corporation. So it shouldn't, basically integration is saying that it shouldn't matter if you earn your income through an incorporated business or if you earn it personally, your tax should be the same. However, this is not always the case because provinces have different provincial tax rates. Saskatchewan is one of the provinces that is not completely integrated. We'll take a look at an example on the next slide to see how that actually works. Okay, so this table shows the concept of integration. In the first column, there's a corporation with active income below the small business deduction limit, which is $500,000 federally. Income below this limit is subject to preferential tax rates. So 9% federally and 2% provincially in Saskatchewan for a combined 11%. So if this business earns $1,000, they will have to pay $110 in tax or 11%. They will then have $890 in after-tax cash to pay as a dividend. Because the corporation was subject to a low tax rate, the dividend that is paid is considered what's called a non-eligible dividend, which is taxed at a higher personal tax rate. So if we look at this in the highest bracket, that rate is 40.37%, which is going to result in $359 in tax on that personal dividend. If we then add up the corporate tax of $110 and the personal tax of $359, your total tax paid personally and in the corporation is $469. So if we then compare that, and if we look at if you just earned that $1,000 personally instead of in a corporation, so if you were taxed at the highest bracket, which on this kind of income would be 47.5%, you would pay $475 in personal tax. Here, we don't need to consider corporate tax since all of this is earned personally. So comparing the two, if you earn in the company and the corporation does not pay a dividend, you can defer tax of $365. A deferral of tax does not mean tax savings. It means you have cash now and could potentially invest that in the business, but you will have to pay tax at some point, so when the dividend is actually paid by the corporation. A tax savings of $6 is obtained from incorporating because you only pay $469 versus that $475. So if Saskatchewan had true integration, that tax savings amount would be $0. In the second column, we have income that is not eligible for the small business deduction and is therefore subject to higher corporate tax rates, 12% provincially and 15% federally for a combined 27%. It should be noted that provincially, Saskatchewan has a small business rate of $600,000. So income earned in that $500,000 to $600,000 range is taxed at 17%, which is 15% federally, so your higher federal rate, and 2% provincially, so your low provincial rate. However, for simplicity, we're just going to exclude that from this current assessment. So here we have the same situation as the first. However, now they are subject to a higher tax rate and only have $730 of after-tax cash to distribute. In this situation, because the corporation is paying a higher tax rate, the dividends can be paid personally and are considered what's called an eligible dividend and have a lower personal tax rate compared to those non-eligible dividends, which is 29.64% in that top bracket. So your total tax paid is then $486 compared to earning all of this personally with $475 in tax. In this situation, you do have a lower tax deferral due to your high corporate tax rate of only $205. And that's just taking your $475 personal tax minus your $270 corporate tax. Corporate tax. And in this situation, it is actually $11 more expensive, as you can see, from a tax perspective to earn income in the corporation. So at the end of the day, true integration is not always achieved due to differences in provincial tax rates. However, a deferral of tax can be substantial when income is earned and retained in a corporation. So we'll take a quick look at an example of this next.
Can I add something here, Briane?
Sure.
So just wanted to add that generally incorporation isn't driven based on that total tax that you paid. It's really about what you need to do in order to invest in your business. And so if you have a business where you are going to need to make continued investments, you're far better off to incorporate because you don't have to pay the high incidence of tax today. You only pay the 11% today if you're a small business limit, leaving $890 available to reinvest in your business. That's not available to a sole proprietor. A sole proprietor is going to pay the full tax today. And Briane was bang on bringing up the deferral. It's really a deferral advantage when you incorporate. You get to control the timing of when you pay that personal layer of tax versus if you're a sole proprietor, you have to pay that tax currently. Thanks.
Awesome. Thanks, Andrea. Okay, so we'll take a more of an in-depth look at the deferral. So the corporate tax rate on that first $500,000 of active income earned is only 11% compared to the highest marginal tax rate of 47.5%. So this means that there is up to a 36.5% tax deferral available to you if you are incorporated, which is what Andrea was speaking to before. So if you are a saver, which that means you aren't taking out every dollar earned from the corporation personally, and therefore can reinvest that money into the business without paying that personal tax on it, i.e. deferring it to later. So we'll look at an example where you save $50,000 a year. Your annual tax deferral is $18,250. So this means, $50,000 taxed personally at the top rate will give you after-tax money of $26,250. $50,000 taxed on the corporation and not taken personally will give the corporation after-tax money of $44,500, which is a deferral of $18,250 to spend on funding corporate operations. So therefore, comparing these two, that $18,250 over that $26,250, you have 69% more cash to use within the corporation than if you earned it personally. Taxes paid at the low rate when income is earned in the corporation. Personal tax is deferred until the income is paid out of the corporation by way of dividends. So there are also planning opportunities available to reduce the tax cost of withdrawing the corporate funds in the future. We'll take a little bit of a look at that next. Okay, so just taking a quick look at some tax planning. So the first one is the tax deferral. So as mentioned earlier in the presentation, when you are incorporated, you are able to defer up to 36.5% of tax and able to reinvest more money into your operations. The next item we have here is income splitting. So if your spouse is involved in your business, income splitting is another way that you can reduce the overall tax you pay. The salary you pay your spouse must represent the market rate for the work performed, which has been about $20,000 to $50,000 seen in practice. So for example, if you are distributing all of the corporate earnings to yourself personally and currently receive $60,000 from your business, you would be paying about $12,500 in personal tax, which we saw in that previous example. If your spouse works in the business, has little to no other income, and they receive a salary of $20,000 for their work in the business, you would then personally receive $40,000 from your business, and in total, you and your spouse would pay $8,300 in personal tax. So you're still receiving the same amount of income, so $60,000, yourself $40,000, your spouse $20,000. However, your tax payable is reduced by $4,400, so about $4,500, because income is no longer pushed into that higher tax bracket, because you are both in those lower first brackets, and you both get to claim your personal tax credits. And I just wanted to briefly note that there were new tax on split income rules introduced by the federal government in 2018. So shareholders can only receive dividends if they are actually actively involved in the business. Spouses and adult children can no longer receive dividends, even though they may be shareholders. So if they do, there's essentially what's called a kiddie tax, and they're going to be taxed on the highest marginal tax rate and lose personal tax credits. So you could consider paying a reasonable salary to children under 18 for work that they are actually contributing to the business. So this previously has been seen to be about $4,000 to $8,000 to children for work in the business. However, tax on split income, or TOSI, as you may have heard, it's a very complex topic. It's outside of the scope of this presentation. However, if you think you may be in this type of situation and would like to get a bit more information on it, you should be reaching out to a tax specialist, and they can kind of help work through that with you. Okay, so we're going to move on to some other tax planning. So that's funding of non-deductible expenses. So the ones listed here are a few common examples of non-deductible expenses. So these expenses are funded with after-tax cash. Due to the differences in the corporate and personal tax rates, if you are incorporated, you will have more after-tax cash left in the corporation to use in the business compared to funding the expenses through a sole proprietorship. We have a little bit of an example to look at how that actually works. So here in the first column, we have a personal tax rate of 47.5%. So if you are in the highest bracket, you will need to earn about $19,100 personally in order to have $10,000 of after-tax cash to fund non-deductible expenses. On the other hand, if you are earning income through a corporation that's earning less than that $500,000, you will only need to earn $11,100 to have $10,000 of corporate tax to fund those non-deductible expenses. This would leave you with an additional $8,000 of income, so that $19,100 minus $11,100 within the corporation, which after corporate tax would be $7,120. So a tax savings of that $7,000. In the second column, we have a personal tax rate of 30%. So if you are in the 30% tax bracket, you will need to earn $14,300 personally to have $10,000 after tax to fund non-deductible expenses. On the other hand, if you are earning income through a corporation, you will only need to earn, again, that $11,100 to have $10,000 to fund non-deductible expenses, leaving you with additional $3,200 of income. After corporate tax would be $2,848. So just a simple example of showing a tax planning strategy of these non-deductible expenses in the corporation. And I'll also note that we've had a few questions just in the question and answer pane. We're just going to take a look at those at the end of the presentation just to keep it moving. Okay.
Dan, do you want me to respond to those to the individuals just so that we make sure that we respond to them? And then at the end of the presentation, we'll go through them as a group, but just in case we run short of time.
Yeah, sure. That would be great. Thanks, Andrea. Okay, so we'll continue on. Just looking at the topic for the sale of a business. So a tax liability on your sale of a business occurs in any kind of structure, including sole proprietor, partnership, and your corporation. So if you sell the assets in the sole proprietorship, the capital gains on that disposition of the assets will be taxed at the personal marginal tax rates because you are operating as a sole proprietor. And as we saw on those previous slides, the highest rate on capital gains is 23.75%. However, if you have a corporation on the sale, of shares of a corporation of that same business, the capital gain on that disposition may qualify as a small business corporation share disposition and be eligible for the lifetime capital gains exemption of about $880,000 in 2020. And this was that amount that I was saying is indexed annually for inflation. So this exemption equates to about $210,000 in tax savings. So it's a pretty substantial amount that could be saved when you sell the shares of a corporation. So if you are planning on selling your business, make sure you are engaging with a tax advisor to take a look at these different kinds of structures before you sell, and not after you sell, because there are different items that you have to look at in order to determine if you are eligible for that exemption before the sale actually occurs, or what needs to be done to make you eligible. So we'll just expand on that a little bit more. So if a decision is made to sell the incorporated business, two general approaches can be taken. The first is for the corporation to sell the assets of the business. The other approach is to sell the shares of the corporation. If the shares are qualified small business corporation shares, the individual may be able to claim their lifetime capital gains exemption. No capital gain exemption is available to the corporation if they sell their assets. So from the vendor's viewpoint, so the person that's selling their business, it's often preferable to sell your shares because, as mentioned, there is potential for that large amount of tax savings if your business does qualify. The purchaser of the business, however, will often prefer to purchase the assets instead of shares. So one reason for this preference is that this approach will normally allow the buyer to claim what's called higher capital cost allowance on the cost of the depreciable assets. So they can claim a larger deduction on those assets in the future. If a sale of assets occurs, the corporation will have to pay tax on income recaptured and capital gains. So tax planning should be done to minimize this tax. And just as a note, when you sell your assets, there is a potential for double tax on that sale because the business is selling the individual assets and has to pay tax on that sale. And then you need to determine how you get that cash out of the business to the shareholder. So another layer of that personal tax this time. And just a note, if you are a sole proprietor and not a corporation, you can only sell your assets because there are no actual shares to be sold. Okay, so moving on to tax on death. So just a note that when a taxpayer passes away, they're going to be deemed to have disposed immediately before their death, so the day before, of each capital property that they owned for proceeds equal to that fair value, upon the fair value when they passed away. So upon the death of a sole proprietor, all the capital assets in that sole proprietorship will be deemed to be disposed of at fair market value. So this can result in gains being taxed at personal marginal tax rates. The disposition of shares of a corporation on the death of a shareholder of that same business, they may have that lifetime capital gains exemption available if they are qualified small business corporation shares. Again, that's going to give you tax savings about $210,000. So we just wanted to note it's recommended for you to discuss with your tax advisor every few years to make sure you have any necessary estate planning in place. Because if you are in a situation where you have a corporation that you own shares in, and there's potential planning to look at to make sure you're eligible for that lifetime capital gains exemption, we want to make sure that that is in place in a timely manner. So I think at that point, it's on to the COVID-19 benefits. So Andrea, I'll hand it over to you to go over these ones.
Sure. Let me just see. I was happily typing away. So with respect to the income tax measures that are available during these uncertain and crazy COVID times, I just wanted to highlight 3 areas that we see a lot of questions, although there are additional programs out there. Generally, Canada Revenue Agency's web pages have vastly improved on the content that they provide, as well as the user friendliness of that content. So where there is one of the programs that you are looking at to see if you qualify, I highly recommend spending some time on the CRA page and just going through the program highlights as well as the FAQs, because those provide a lot of guidance. They're updated regularly and a very good starting place. So by way of background with respect to wage subsidies, initially the first wage subsidy that was provided was 10% based on payroll withholding. So what would happen is, to a maximum of $25,000 per corporation, there would be the ability to reduce your payroll withholdings by 10% of the wages. This was a program that was only in place from March through to June. And you may, if you have qualified for that program and took advantage of that program, you may have received lately a request to file an information return based on that. So this program was, it was very modest in the beginning. I think probably before anybody truly understood the magnitude of what we were facing. And very quickly after that was released, the Canadian Emergency Wage Subsidy was issued. It was first drafted in April, and then there was a significant overhaul in July. I've copied in here a reference for some Deloitte content that goes into detail on the July 27th enactments, as well just a little table from that, because I think it's useful to understand what the changes that took place in July are. So first, for periods 1 to 4, the subsidy was a lot less complex. You needed to take a look at your revenue and determine whether it declined enough to qualify. If you did meet the requisite revenue decline, then you were able to qualify for up to $847 per individual that you hired. Okay, in July, the new legislation came in, and we'll call it version 2.0. When it came in, it basically recognized that 30% revenue decline was a bright line, and it prevented some some companies and perhaps individuals from qualifying. So they instead issued a sliding scale. So if your revenue declined by 5%, you still qualified for a subsidy, but at a much lower rate than if your revenue declined by more than 70%. So when you're looking at your own businesses, first steps first is to take a look at your current year revenues in comparison with the same period of the prior year, or in comparison with the average of January and February. That's for periods 1 to 4. For periods 4 through 6, your revenue decline is based on year over year, so July versus July, or based on a 3-month average in 2019, so July and then perhaps March through July. Or you still have the ability to compare against the January, February 2020. So here's a nice little scale that you can take a look at, and you can see that there's substantial subsidy available to keep employers able to hire and continue to employ their individuals as we ride out the storm. It ends here in November, but of course, there's in period 9, but since this time, of course, there's been an enactment that extends the program likely through to next year. We just don't, well, definitely through to next year. We just don't have the details on that. Yeah, so that's the wage subsidy. For those individuals, and Briane, I'll get you to advance to the next slide, please. For those corporations that qualify, I think the recommendation that we have for you is to just keep really good details on how you came to your qualification. So the first, there's been 44 billion advanced as of just last week. And so we do expect CRA to vigorously audit. In fact, I was on a call yesterday night with CRA leading the conversation about their response to the CEWS program. And of course, when there's that amount of outlay, there's a fair amount of work happening in the background in terms of audit activity and upcoming audit activity. So the best thing people can do when they're filing is to have really nice, clean files that document the monthly revenue decline and how people came to understand that they qualified. Then you need your payroll records, and some of that involves a little bit of slicing and dicing to meet the requisite periods that CRA has. But you'll have those payroll records, and it should be able to substantiate that you qualify for these individuals. And then, of course, there's an attestation form, which you will need to file as well with that. And that's really going to be how you work if your claim gets audited. That how you work with the auditor is by having a really nice file to work through and show how you came up with your claim. You can advance to the next slide. Okay. Another new thing that has been issued late summer or early fall here was, with all of these programs coming out, of course, CRA is going to need some background information where they can verify the claims that people have made. So in order to allow for validation, there's been some changes to T4 reporting requirements. So the T4 reporting requirements now include 4 codes for sure, March through May, May through July, July through August, and August and September. But I anticipate this will be updated shortly to include the rest of the periods. And so there's just an extra field when you're preparing your T4s this year that you will need to include to show the earnings for these periods. And I suspect that will be used to cross-reference the various programs and validate the claims. Okay, and you can go to the next slide. I did include also on here a link to considerations for helping employees, because a hot topic these days is the home office expenses. And so when I go into that document, you'll see that there is some information for you. And I'll run through that in just a moment here. But I did want to highlight in September, there was a consultation period where CRA looked at the current form T2200 and asked for insights from the community. They have not released the findings of their consultation period. So I would say that we really need to be cognizant of CRA's updates on their webpage, because I do believe there's further guidance coming here for home office expenses. But as of right now, here's what we know. In order for employees to deduct expenses from their income, they will be required, there needs to be a requirement that they work from home. So not optional, a requirement. And if there is a requirement, then the employer will issue that form T2200 Declaration of Conditions of Employment. On there, if employees qualify for their home office expenses, they will be able to deduct a pro rata portion of electricity, heating, cleaning materials, and minor repairs. Some of the other items that go along with having a home, such as a mortgage or property taxes and insurance, these are not included in what can be deducted by an employee. But anyway, I do encourage everyone to take a look at this article because it'll provide you some nice considerations with respect to home office expenses, financial support offered to employees working from home, considerations related to parking and mileage reimbursements, some taxable benefit information, and just general good COVID-19 information useful when you're an employee. Another program that I wanted to highlight here was the Canadian Emergency Banking Account, which many people may have qualified for and applied for already. Much like the Qs, this came in a version 1.0 and a version 2.0 and an expansion coming up. So originally this was a $40,000 loan repayable, or interest-free loan, which would be repayable before December 31st, 2022. Where the applicant did repay this loan by this time, they would be eligible for some debt forgiveness of up to $10,000. So if you qualify under the original stream, the payroll stream, those criteria is actually pretty small. You need to have a payroll number and be able to demonstrate that the payroll from the prior year was between 20,000 and 1.5 million, so a pretty large gap. The other thing is there is requirements that these funds be used to pay for non-deferrable expenses, and that's right in the loan agreement. It's administered by the banks, and you'll see those criteria right in the loan agreement. There's a second stream that came out during the summer because let's face it, there are some businesses that are out there that maybe didn't have payroll and they still had non-deferrable expenses. So the second stream that came out was the same loan, $40,000 with the $10,000 forgivable. And those, the criteria to fit in here would be to have non-deferrable expenses. Those are expenses in which there was a contractual obligation as of March 1st, 2020. So that's a narrow scope to qualify, but if you do qualify, then this is a great way to help cover off some of those expenses. And then coming soon, as announced in October, there is an expansion from $40,000 to $60,000. So more details coming there as well. Such a vast area, so I just narrowed it down to a few considerations. But perhaps we can maybe turn it over to some of the questions and answers now. The first question, which I took a shot at answering while Briane was talking, was, what does active business income mean here? Can you explain that in detail? And so sometimes I think when you are trying to explain something, it's easier to start with what the opposite is. So we generally talk about income in two forms when we're talking about Canadian corporations. Those that earn passive income, that might be rent, royalties, dividends, and capital gains. That's income that just happens without your participation. It happens by virtue of your investment. The opposite would be active income, and that's income that requires active engagement. So you likely have employees or inventory. It could be retail, wholesale, manufacturing, and sales. So I hope that adequately helps you distinguish between active income and which qualifies for the small business deduction, and passive income, which has a different regime. There was another question here with respect with the new rules, the new TOSI rules. Can you review what it means for your spouse to work in the business? Okay, so the TOSI rules allow for an individual to receive a dividend without TOSI applying, where it's an excluded business, and an excluded business by definition is one where the shareholder either meets this bright line test where they work an average of 20 hours per week throughout the year. Alternatively, if they are engaged on a regular, continuous, and substantial basis. Now that is a more subjective filing position. And so if you're to rely on that regular, continuous, and substantial basis, one of the factors that I would maybe consider is whether, removing that person would have a significant impact to the organization. Then for sure that, then there's likely a filing position that individual would be able to consider that business an excluded business. So working in the business means, carrying on activities for the business in the pursuit of profit for the business. Hopefully that provides you some guidance in what you were looking for. Briane, I don't know if there's, maybe take a run at some of these other questions here that you may want to chime in on. I'll do this next one and then maybe you can take a look at some of the others. Are there any rules of thumb that you can use to help clients figure out whether it's time to incorporate or not? I often think incorporation has as much of a legal implication as it does a tax implication. And so anytime that you're operating a business that carries a certain amount of risk to it, reaching out to legal counsel to talk about incorporation as a way to segregate your personal assets and your business assets is a good idea. So a rule of thumb is, yes, when there's risk involved in the business, it's often a good time to look at incorporation. From a tax perspective, I think where I would go if I was looking at incorporating or not, it's whether or not I was a saver or I needed to reinvest in my business versus a spender. If you need to consume to fund your personal life, most of the revenue, the net income created from the business, then you're not going to be in a much different tax position whether you continue to operate as a sole proprietorship or if you incorporate. On the other hand, where you have a business that requires significant reinvestment, or where you're a saver, you don't need to consume the net income from the business, then incorporation makes sense from a tax perspective. But I would just, again, highlight that the legal considerations are very important here as well. Maybe I'll pass it off to Briane to look at a question or two here.
Yeah, for sure. Yeah, I'll take a look at the next couple ones. So the next one we have is, can the shares be sold via an exchange for personal assistance, or does it actually have to be a cash transfer? So for this one, Andrea, you can correct me on this one, but I believe you could sell for personal assistance. You would have to look at the fair value of the shares. I guess when it comes to selling the shares of your business, you also need to consider that you're giving up a portion of your business when you're selling the shares. So you aren't just giving somebody some kind of cash payment for whatever assistance they're providing you. They also now have an ownership in your business. So I guess that's just another consideration.
Yeah, and I'll add just a little bit more context. shareholder disputes happen all the time. And so one of the things that we can do to make sure that there's clarity is to have clear terms of purchase and clear terms of sale. So if you were to sell shares, I would recommend the consideration be for cash. If you were to sell for some other consideration, I would want that legally documented. And the other piece of information that's important here is whether or not you transact in cash or not, there is a reportable transaction here. And so if you sell something worth $5, you're going to need to report $5 of proceeds. If you sell for services worth $5, you still need to, report $5 worth of proceeds. And so anytime you're using some sort of in-kind proceeds, that really muddies the water, but it does not really change the tax consequence. You really need to come up with a fair market value for those services.
Awesome.
Okay, I'll pass it back to you.
Thanks, Andrea. So I'll just move to the next question, and I'll bring up a slide here. So next question is, I thought there was a way to pull dividends at a lower tax rate. So this kind of goes back to a few of the examples that we were looking at. I'll just first bring up the different tax rates just to take a look at that one. So here, yes, there is dividends are taxed at different tax rates depending on what kind of dividend they are. So here we have the two right columns, tax rate on non-eligible dividends and tax rate on eligible dividends. So you can see that there are differences. So your eligible dividends are taxed at a lower tax rate. And if we think back to that example, that's because eligible dividends are paid when a corporation pays higher tax rates. So when corporations aren't eligible for that preferential rate, that 11% we were looking at, when they're taxed at that higher marginal rate, they're developing a pool where they're actually able to go and pay out of that. And so when you receive those eligible dividends personally, because your corporation has already paid high tax rate, you personally don't have to pay as high of a tax rate. And depending on which bracket you're in, that can vary as well. Whereas for your non-eligible dividends, your corporation is going to be taxed on a more preferential tax rate, so a lower tax rate. So when those are paid out to you personally, in order for integration to apply, you have to be paying a higher personal tax rate. Hopefully that kind of makes sense and answers that question. And Andrea, I think the next few, they might be more on the COVID-19 programs. I think that's when they came up.
Okay, so the first one here looks like it's based on queues. The requisite to fall into the queues is based on actual revenue decline and not based on any projections or business plans. So I think your answer is correct, that where a company has been gearing up for a greater amount of revenue, but that didn't happen, then that's probably just a red herring, probably something that doesn't factor into the calculation. The next question, if a company has been gearing up and wasn't able to pay a wage to the sole shareholder, is a payment of the cash advance the way to do it? Thus, it is viewed as a dividend payment rather than employment income. This one's pretty fact specific. I would invite you to reach out afterwards to chat about this one or talk with your tax advisor. There was some recent information that was drawn up about some of these types of circumstances. And so, it's probably best to go through that one offline. What was the agreement that a corporation can have a lawyer draw up? Well, there's many types of agreements that you may have a lawyer draw up, but the one that was specifically referred to in this instance was a shareholder agreement. And even if it was a partnership agreement, where you have individuals that are co-operating a business, you can usually protect yourselves from the predictable things that will happen in the period of co-ownership. So the predictable things that may happen in the period of co-ownership is obviously sharing of profits and dividends, whether you're going to share proportionately, but also some of the softer things in life. So death, disability, divorce, or dispute. So where you have a shareholders agreement, generally that will provide a path to work through those common things that happen when you co-own a business. Yeah, so I think that's the answer to that one. I think we are just past 1 o'clock, so a little bit beyond the hour. I don't see any other questions, so maybe we should hand it back to our WESK friends.
Great. Well, thank you so much to Andrea and Briane for the great presentation today and for answering some of our audience questions. This brings our Learning Month with Deloitte series to a close. So thanks to everyone who joined us today or who joined us for the other 4 sessions in the series. I hope you found them valuable and that they will help you in your business going forward. As I mentioned before, you'll be receiving an email from us tomorrow with a link to rewatch this presentation. And it's also available on our small business resources page at wesk.ca. All right, with that, I will let everybody go. Have a great afternoon. Have a safe and fun Halloween when you get to it. We'll talk to you later.